Hello everyone! Even though summer is still ongoing, I promised not to appear until September, when the next season of FinFact begins. Of course, what is happening in the markets has led to a huge number of questions I received both in Telegram and in personal messages. I decided to record a short video about what is happening and what to expect in the next couple of weeks. In fact, I believe that the main epicenter of events is still ahead of us. Well, as you know, it's usually March-September, so I'm betting that something intense will start in September. Or maybe it won't. Let's figure it out. A small digression. In the next couple of weeks, I will organize a small survey in my Telegram channel regarding the information I provide. I would like to know a bit more. What specifically interests each of you, and how can I adjust my proposal from an analytical perspective to better suit your needs? Therefore, there will be certain calls to attend specific interviews. My request is simply to respond and let me know what would be of interest to you. This will help me to shape a more interesting proposal for you from an analytical perspective. Now, let's finally return to the markets and see what has happened. I think that over the last couple of days, especially on Friday and Monday, everyone has managed to get quite scared. At least, this was observed in many Telegram channels, including mine, where it was all doom and gloom, everything was lost, everything was terrible. In reality, I remained relatively calm. Of course, the events that have occurred could have escalated into something more global. So far, it hasn't escalated. Let's sort this out step by step. This doesn't mean that I'm feeling overly optimistic. Yes, in my main thesis, I believe that we likely have another month or two ahead of us with current events that will be, if not a bull run. And now I will explain a bit of my logic to you. What happened on Friday and Monday? As you probably already know from reading and watching, were certainly two factors that seriously influenced the whole situation. The first factor that is currently being actively discussed in the media is that, of course, the carried rates in Japan have been knocked out. After that, on Monday, there were liquidations of short positions on AVIX. And, accordingly, we ended up with quite a serious roller coaster. It should be added that at the end of the month, undoubtedly, the interest rate hike by the Bank of Japan left everyone, including myself, a bit stunned by how one can raise rates in a recessionary environment, but it certainly has its logic. Interestingly, at this point, I was writing my analytical report on the Japanese yen. Today, we will not delve into these details, but a few words, of course, must be said. What we received in the context of the Japanese central bank's interest rate hike led to a situation that was politically motivated, including from the Americans, as there was a need to strengthen the yen. And the strengthening turned out to be modest a surprise in terms of speed, as it occurred. In other words, we jumped from 160 to 140 in one moment. This led to the fact that these carry trade positions, where you borrow money in cheap yen and continue to speculate in other markets. Essentially, all these positions were liquidated. It is important to consider that Japanese banks, as such, are among the main players in terms of these positions. Their access to yen is unlimited, they have swap lines with the Federal Reserve System, and, for the most part, Japanese central banks are the main circulators of dollar liquidity, at least in the Asian region. But what we saw when the yen surged was sharp sell-offs in the currencies of emerging markets. The Mexican peso, the Brazilian real, they all plummeted. If we simply look at this chart, many often say that the differences between the interest rates of the Fed and the Bank of Japan, represented by the orange line, are here in the 10-year bonds. As soon as the Japanese slightly raised the interest rate, it caused the exchange rate of the Kenny dollar to follow the movement of the interest rate differential. And this led to the fact that this huge leverage in the system, which was present, began to be forced out. Undoubtedly, what we witnessed was definitely a local event. It could have been much worse. I think the worst part is still to come, and I will explain it to you a little bit now. Undoubtedly, the poor labor market data, that I have been talking about for quite some time in America has finally started to materialize. We are seeing a rise in unemployment, and we are witnessing a very weak labor market. Ultimately, the discussion led to the conclusion that not only did the Nikkei drop by 20%, but more importantly, Japanese banks fell by 30%. In other words, the risk of the Japanese banking system as a key circulator was heavily priced in, and the risks were actually very serious. In the next moment, they started to liquidate positions on short volatility. You can see here that even in the ETFs on derivatives, there were very sharp outflows. And, undoubtedly, these speculative sentiments led to the VIX soaring dramatically on Monday. This caused a certain level of panic. But now, today is Wednesday, everything has calmed down a bit and looks relatively wonderful, and all is well. To summarize and see what we have ultimately and conclusively achieved and accomplished. For the first time, the Dow Jones fell by more than 1,000 points. We have seen that the inversion on the 2-year treasuries has gone to zero. Now the inversion has recovered a little. There were very significant purchases in American treasuries. The Russell 2000, which we will discuss separately, has fallen by nearly 10%. All major chip companies have been significantly affected and impacted. That is to say, the index of these semiconductors has dropped by almost 25%. The Magnificent Seven are heading for the bin. And, generally speaking, for the most part, even with the Standard & Poor's index, all 11 sectors, Standard & Poor's equally weighted, if we look at all the Standard & Poor's sectors, all closed down in the red territory in the market. Undoubtedly, discussions immediately began about the need to lower interest rates. We saw that shortly before this event, Bill Dudley, one of the members of the Federal Open Market Committee, indeed stated that rates should be lowered now. In my opinion, he certainly did not mention the deteriorating economic indicators. We also have issues in the repo markets, which we will discuss in just a moment. But we have seen that the market is now pricing in the next event after this. There is a 95% chance that there will be a 50 basis point rate cut in September. We expect a 4.5% reduction in the rate by the end of the year and 5.5% by the end of January. The so-called terminal rates, which are considered, well, these are again some economic gadgets. The normal rate somewhere is around 3.25 to 3.50. 3.25 to 3.50, 0 point. Well, accordingly, we indeed have a huge demand for interest rate cuts. And on Monday, especially the futures on SOFR, which is a replacement for LIBOR. What has been removed is a very bad indicator, because LIBOR was an unsecured interbank funding rate. It has been replaced by SOFR, which is a secured instrument. It has many flaws. I have a video about the difference between SOFR and LIBOR on my channel, so look for it and watch. But what is, and we play with that. All rates have sharply gone up, which means that it has become very clear that rates will be reduced very aggressively. Paul Krugman said that the rate needs to be lowered right now. Not in September, but right now, because the markets are in a panic. Paul Krugman is an interesting fellow. In January, if we look at his tweet, what he wrote, that this is not an economy that is all okay. Goldilocks, in his understanding, is like a bowl of porridge that is neither too hot nor too cold. And our economy, in this case the American one, is very hot in terms of GDP growth and very pleasantly cool in terms of inflation. In other words, he hinted that the high GDP growth and the continuously decreasing inflation in the economy are all great. In just 6 months, it seems that the situation has completely changed. However, as I constantly say, the situation hasn't gone anywhere and the dynamics continue. They have been ongoing since 2018. I always say that it is not the central bank that sets the rates, but the market that sets the rates. If the central bank is lowering rates, it means that the economy is in a bad state, not the other way around, and accordingly, this is exactly the dynamic we are currently in. In other words, what we have seen in the post-pandemic period, all these effects and imbalances are now being marginalized and, accordingly, are turning into the usual trend that we have observed over the last 6 to 7 years. What needs to be understood, and what we have seen, is that, of course, now before the elections, the Federal Reserve and Yellen certainly do not want any waves in the markets, do not want upheavals and so on and so forth. For them, the situation is important. The main thing now is to maintain stability so that the elections can proceed smoothly. And these discussions about interest rate cuts are certainly making everyone anxious because the consequences that may arise, so to speak, the second and third derivative effects, could be unpredictable at this stage. We can see how skewed the markets are. Let's talk about how precarious everything is right now, and, accordingly, the dynamics that we are possibly seeing now. If we recall what happened after 2020, when it didn't matter, pandemic, everything went up. Then there was a war, and everything went up. Then, as we say, bad news, good news, meaning that bad news for the market. Or actually good news. It is quite possible that we are entering a new dynamic where bad news actually becomes bad news. What we are currently seeing and what I am paying the most attention to is undoubtedly the spreads. Spreads in the corporate bond market. Why? The Japanese, actually, if you remember, in June there was, what was it called, Nuri Chicken Bank, in general. A news report has emerged stating that a major Japanese player has announced the sale of 63 billion in treasury balances. This caused a mixed reaction at the time, but when we looked into it and dug deeper, it became clear what was actually happening. Given the relatively low interest rates, what were the Japanese up to? A considerable number of players were involved in this. The fact that the guys were essentially moving away from the tool of securitarized various papers. These are corporate bonds. They are the same as real estate. In other words, you are looking at those CLO instruments when you consider what caused the explosion in 2008, the Japanese were moving towards increasingly risky tranches of these securities, trying to achieve higher and higher yields. Because with a falling yen, your costs for funding these positions have been constantly increasing. Accordingly, when treasury bonds provide a certain yield and your funding costs are constantly rising, you need to go, as the Americans say, down the risk curve, meaning you have to take on more risk. Consequently, the Japanese have increasingly invested in riskier securities and tranches. We are currently observing quite a significant movement in terms of junk bonds. We are seeing movement specifically in these various securitized papers. There are big problems in Europe, as all banks are currently trying to. The only lending happening in Europe right now is going to funds that are involved in such matters, meaning they are currently trying to reduce the possibility of defaults on these securities so that they do not appear on the balance sheets, as the situation is quite fragile. But if we look at the corporate spreads, on Monday you can see on these charts above the investment grade papers, and below are the junk bonds. The jump was very significant. We have seen again, if we look at it in a global context. In a global galactic context, what we observe is that VIK has jumped, and how correctly the spreads follow this. The spread is the red line that follows this movement, which we have not seen yet. What we can expect in the near future is that the spreads at this level will be around 4%. By itself, this doesn't mean that it's something terrible, but if we start testing and breaking through this line, then things could really go south. It's important to give oneself due credit. This is likely not a question for tomorrow or the day after, but it is an area that we all need to pay attention to, because that is where one of the main issues is likely buried. In other words, the first such underground jolt we received was due to carry trades, and now we are waiting for the corpses to start surfacing, and when the biggest elephant swims in, we will understand who, as Mr. Buffett said, was actually swimming in this pond without any trunks. While this is not yet visible, it seems to me that we still have a certain amount of time regarding this. What do we get as a result of such dynamics? Undoubtedly, we should expect that liquidity in the markets will deteriorate. And when we talk about the development of a situation, liquidity is everything that drives the asset. These are the spreads that we receive. It can now be considered a basis for liquidity to flow into the markets. Yes, the last 6 months have been difficult with liquidity. Right now, it is likely that we can expect some improvement. Firstly, Lacey Hunt in his latest report presented his dollar liquidity index. In other words, we have not seen such a decline in liquidity over the past 40 years. And if we look at the liquidity index of American bonds, the fact that the line has shot up is actually a deterioration of liquidity, not an improvement. In other words, the higher the line, the greater the stress. Accordingly, what we are seeing is that liquidity in the markets is quite thin. At the moment, let's say, it is indeed currently not critical. Because, essentially, if we look at the markets, we'll get to that in a moment, the situation is indeed tense, but we don't see any significant stresses at the moment. But this is most likely a harbinger of the fact that sooner or later we will come to such a situation. What we are seeing is that American dealers are indeed certainly and definitely starting to stock up on treejacks to the brim. On one hand, I often hear discussions that the issuance of bonds is so high that it is terrible, and the balances are clogged. The balances are indeed clogged. But it is important to understand that banks always think in terms of profit. Any frictions in the markets lead to banks seeking opportunities to capitalize on them. And now just imagine the simple logic that if something goes wrong now, and you have the main tool of all securitization, the entire collateral instrument, who holds it? You will be able to generate such spreads. Therefore, it is most likely a speculative position of the banks, which are simply preparing for some serious turmoil. They do not want to end up in the same situation as in 2008, so they are simply preparing for that scenario. The signal is very poor because, once again, it is not the amount of liquidity or the number of collateral instruments, but their circulation that determines what is happening in the segment. And if we now look at the positions of the treasurers, which are practically at the levels of the worst times, like those in the 20s, this is a very bad signal. It means that banks are preparing for something that could hit at any moment. If we look at the difference between Fed funds and SOFR, which roughly indicates stress in the repo markets, then yes, there is certainly stress. We see that it is at an extreme level and quite significant. However, if we consider other periods, such severe episodes can be relatively short, and at the moment, such extreme conditions are not actually observed. What we are observing is that if we look, it is the spreads in the repo markets. And the purple line is basically the spread, roughly speaking. You have different players. In September, I will take down the jungle of the system about the wrap markets so that we all understand what is being discussed. So here, in fact, is the 99th percentile, so to speak, which represents the 1% of the most risky players, and during the upswing, they essentially fund these trades for themselves. These are typically high-risk hedge funds with high leverage. We see that these spreads are, if not at their maximums, at least testing quite serious boundaries, 25 basis points. If we break out to the upside, then there could be some upheavals. That is to say, a certain level of stress is undoubtedly present, and if this stress continues to develop, the topic will turn out to be that the rate cut is actually not related to the fact that the situation in the economy is not good for you, because what we are currently seeing in the EPO markets, if these rates jump and start to spread, all these pipes through which liquidity flows could become clogged, and then we all have problems. And what could prompt a decrease in rates? Essentially, a significant demand for treasuries when rates are lowered. This generally helps dealers to clear their balances. On one hand, dealers want to profit from this. On the other hand, if there is an aggressive reduction in rates and they have stocked up in time, they will be able to realize it. You wash away all these tranches from the bank's balances and, once again, establish relatively good liquidity. I expect that QT will be completely closed soon, as it is somewhat obstructive. The problem for banks right now is that, essentially, the balances are actually clogged due to regulation, and you have two options. Either you will end QT, but that will only last us a couple of months, or you will effectively start lowering the rates. If you see that, broadly speaking, the reverse repo regarding what is said about liquidity, in my opinion, has a somewhat different connotation, but basically, this dynamic that the reverse repo has completely stalled for several months has two factors. On one hand, this is a factor that if this money starts to leave, it means that spreads will go up, which means volatility. On the other hand, this is the dynamics of the fact that the risks on banks' balance sheets in the current configuration cannot push them there. In other words, essentially, there has simply been a blockage in the system. Again, I won't explain it now. I'll explain everything in September. You have a bottleneck in the system where certain players in the markets have risks and volumes that prevent effective distribution of this liquidity throughout the system. It's complicated. I understand. Just forget about it, so to speak. What are we going to observe now? Typically, the seasonality of bonds is from August to September, when yields always rise. We had two scenarios. There was a decline of 6 to 7% in yields. If it had continued, it would have been a complete disaster. Right now, we have seen a rebound, and I think if we look at the decades, we can see how much they have fallen. The yellow, blue, green lines represent the average values, based on 150 to 200 days. We need to bounce back a bit somewhere. We should actually go to around 4.2 on the 10-year bonds to calm down a little. In my opinion, in the fourth quarter we will see an explosive drive in the bonds, meaning both TLT and other players will be involved. I like 2-year bonds, but in general, it makes complete sense to hold a position in the bands right now. Let's see what will happen in the next couple of weeks. So don't rush, but it's essential to hold on to the bonds. 3 questions we should ask ourselves. What has happened? We have 3 options. On one hand, it's clear what I said. The leverage was wiped out. Everything is fine. The leverage has returned. All is great. On the other hand, of course, there suddenly came the realization that the American economy is faltering, and the whole discussion about this SAMRU, when they are already saying that it is not a rule at all, and it is self-fulfilling, so to speak, that things are not so bad. It is quite possible that the market's realization that there has been no soft landing, there will be no soft landing, and there could not have been one, has finally led to such movements. And the third possibility is that all the hype is about artificial intelligence. And we have already received a statement from Google that their expectations, to put it mildly, do not correspond to reality. In my opinion, based on what I have read, the total revenue and turnover from all these models currently amounts to approximately $1.5 billion. Quite funny figures compared to the amounts that are being poured in. And accordingly, the expectations in terms of valuations are undoubtedly inflated. On the left side, this is a comparison of the black line before Cisco in the 2000s and what is currently happening with Nvidia. If we look at peak.com on the right side and where we are now, it is certainly reasonable to expect that this collapse of these exceptional expectations is bound to happen. I won't go into details right now in the sense that this isn't about money running around, but rather an exclusive reassessment of risks. But it is necessary to say the following. What is currently expected, and the discussion that I have been asked many questions about, is what is happening, and whether it is time to move into small caps. Yes, a rate cut as such always has a positive impact, specifically for small cap companies. Why? Firstly, in America, companies are generally financed at a floating rate. Their balances are not like those of Apple or Microsoft. Undoubtedly, you see the dynamics where a decrease in rates leads to a positive outlook for their cash flows, meaning you get a broader movement in the market. If we look at it from this perspective, which is quite possible, we need to understand that due to ETFs and passive instruments, we are experiencing a completely different dynamic. If we look at when the surge began, we saw a 10+% increase in small caps, specifically with the EVM ETF, where 10 billion was injected directly into the ETF, and the Russell 2000 index grew by 200 billion. In other words, as I often say, our movement is such that every dollar entering the market in the S&P moves the market capitalization by 5. Here we see that $1 moves the capitalization by 17. What we have observed over the last 4 years is a one-sided game. And here we see that it's always played in one direction, but at some point, we may experience a reversal in terms of capital movement. Now we will also talk about why I remain bullish on stocks. If we look at this chart, we can see how significantly capital movement affects the dynamics of market valuations, that is, indeed, from left to right. Companies that, with a certain change in trading, significantly affect the index. So the first is Nvidia. If it has risen by 6%, then its average is, well, there you go. The contribution to the index change reaches 20%. We are looking at Microsoft, Meta, and Amazon. In other words, these magnificent 7 are passive movements that continuously influence the growth of the indices. The indices are quite stable in this regard as long as the flows into these instruments do not cease. And to this day, we have not seen any reverse dynamics. But what ultimately awaits us indeed is Comrade Hasman. I often share his research and findings frequently in my channel, where the blue line should drop to and where the S&P index should fall in order to reach the average values with the expected 10-year yield. And the red line is essentially what is actually, truly, and really happening in the S&P index. Accordingly, based on this metric, in the near future, whether it be a year, 6 months, or 2, we will still return to the point where the S&P should drop by 70%. Whether we like it or not, in my opinion, how this will happen is another question. What is certain is that we will definitely get there. The fact that the markets are currently completely subject to passive movements and ETFs suggests that there will likely be a prolonged period of stagnation, as with all indicators, where we will experience a slow decline, followed by a rather significant drop. Perhaps I am wrong, but it feels that way right now. And in my Telegram channel, I recently just posted about the dynamics of the rates. What will happen to the markets if interest rates start to decrease? And, in my opinion, in the short term, and most likely in September, they will certainly lower the rates. We need to consider 1 thing or 3 factors that will undoubtedly play a role. Firstly, a decrease in interest rates according to classical economic theory leads to a reduction in the discount rate of the cash fund. Consequently, your capital is worth less and your valuations, the fundamental value of your cash flows, are increasing. Positive for stocks. The second factor that undoubtedly also plays a role in this is rebalancing. Since the whole world operates on a 40-60 model, with 60% in stocks and 40% in bonds, we must take into account that large players systematically rebalance their portfolios. Something has grown, it needs to be sold and rebalanced. Accordingly, the decrease in interest rates, which leads to an increase in bond prices, means that large investors must sell bonds in order to buy stocks. Once again, we are presented with a certain scenario that is theoretically positive for the stock. This is not something that will happen overnight. It is a fairly long period that could last a year and a half. Therefore, everyone has their own committees and so on, but fundamentally, this definitely provides stability for the stock. On the other hand, we are witnessing a trend where, with an aging population and poor demographics, we are now entering years when baby boomers in America, at least, are reaching peak levels and retiring, causing all portfolio allocations to shift towards bonds. So, trend-wise, if we set interest rates aside for now, the major players should, on the contrary, be selling stocks and buying bonds, right? But if there is a decline in stocks and a decrease in rates, then the rise in the value of bonds reduces the pressure on these funds in terms of selling. Accordingly, you need to sell less, and the rebalancing is not as active, which provides an additional mechanism, a sort of cushion, that again softens the index. In this regard, if we look at these three factors, a rate cut can initially be positive for stocks. I understand that now everyone will start saying that yes, when the rate decreases, stocks crash because we will have a recession. I get it. The level of debt, the level of liquidity that will come in any case. And perhaps this August event, what we have just seen, is simply a harbinger of how much liquidity is being pumped in. And we place a bet on this. In my opinion, yes. Are there any specific political obstacles to this? Certainly, yes. The Fed does not want to lower the rate because it could cause panic. But once again, geopolitics comes into play. What will happen with Iran? What will happen with Israel? And what will continue? And, in general, all this chaos happening in the geopolitical sphere also affects this. No one knows how to calculate it. Accordingly, in anticipation of liquidity, a rate cut may have a positive effect during a certain period. In my honest opinion, what we are currently witnessing is very reminiscent of the day before Lehman Brothers went bankrupt, when half of the participants at the Fed meeting were saying that everything was perfectly fine and everything would be okay. We must assume that the Federal Reserve is very much behind in lowering interest rates and that, most likely, the rate cuts will be avalanche-like. The first stage can be perceived specifically in terms of the repo and the influx of liquidity, slightly reducing the pressure, and we will see a certain positive dynamic. But, in my opinion, if we look at this from a global galactic perspective, then, of course, we are moving towards a good, very tough mix. And 2008 will seem relatively like a kindergarten to us. When this will happen, I do not know. I really dislike periods like, March to September. But in principle, even if we miss this window, the next one will catch up with us sooner or later. What can I say about other assets? I am super bullish on gold. If we look at this chart, based on the technical formation, over the last, roughly 20 years, there have been several setups like this, so we should be heading towards 3.5. 3.5 is certainly a bit much, but I think 3, as I mentioned, will be my target, and it seems quite realistic to me. I believe that the interest rate cut and discussions about liquidity will have an extremely positive effect on cryptocurrency in the short term. Solana, Ether, altcoin, season, one can argue whether it will happen or not. I believe that you can definitely place a certain bet on this. Bonds look great right now. Even if crypto takes a hit, gold and bonds provide a balance for what you have. That's it. I've rambled on today. I didn't intend to talk this much, but that's how it turned out. Once again, we are starting a new season in September. I promised to make a video about the jungle system regarding turnips. There will also be a video about artificial intelligence in August. Lema is out for a walk. Support this format. The views weren't very high, but overall, the feedback is very positive. I need to understand whether we want to continue filming or not. And, of course, I would like to ask you to participate a bit more actively in Telegram now, as we will be conducting a survey from an analytical perspective on what I can offer you and how I can be of help. That's all for today, and to everyone, of course, FinFac, goodbye.